on session 10. Session 10 is, we are looking at cost, volume, profit analysis. In session 10, we are looking at cost, volume, profit analysis. Now, every organization is interested in making profit from their production, whether of goods or service. The objective is to make the best profit that they could make at a minimal cost, and offering good quality of products or services. So the objective is to ensure that the organization reduces costs, produces at the minimum cost, produce that of good quality in line with customers' demand, and at the end of the day make the profit that they could best make given the circumstances that they are facing. So to look at this now, we would look at an analysis involving cost, involving volume, and involving profit, so that we could see how the interrelationship of these three concepts. So at the end of this session, students are expected to be able to explain the concept of cost, volume, profit analysis, and then do an illustration of the break-even, be able to demonstrate the break-even analysis. So that's what we're going to do in this session. So the cost volume analysis, volume profit analysis involves analysis of how cost, revenues, and profits are related to sales volume. How cost, revenue, and profit is related to volume. Basically, that is the analysis that you want the CVP is doing. Therefore, the concern here is to determine or to predict the effect of changes in cost and volume on profit. What happens to profit when volume changes? What happens to cost when volume changes? So that analysis, that relationship is very, very essential in to management, and that's exactly what we're trying to do in this session. So the CVP, or the cost volume profit analysis, seeks to find answers to certain questions. Some of these questions are: one, what will be the cost of production under different circumstances? What will be the cost of production? What has to be the volume of production to be able to maybe to break even or to be able to make a certain profit? What volume of production should we produce? How many units of each product can be manufactured in order to earn a targeted profit? That's an important question. What is the difference between the selling price and the cost of production? That's important. What are the effects of a percentage change or a percentage increase or decrease in the cost on production, on volume, and on profit? So these are some of the questions that we will attempt to find answers on as far as this session is concerned. All right. So the technique of cost, volume, profit analysis is very helpful in different areas. One, it helps in budgeting, the budgeting process, that is the understanding and the application of cost, volume, profit analysis helps in the budgeting process. The volume of sales required to make a profit and the safety margins, for a certain profit level can be measured. It helps in pricing decisions. It helps in volume decisions. It helps in decisions of sales mix. What mix of sales are we going to make to be able to achieve a certain so in deciding what proportions of each product should be sold, decisions also affecting the cost structure and production capacity are also very, very germane in this so generally the cost volume profit analysis is an analysis that involves how total cost, total revenue, and total profits are related to sales volume, and therefore, concerned with predicting the effects of changes in cost and sales volume on profit. So basically, that's what the concept is talking about. So an understanding of the interrelationship between these three factors, or three concepts, and of the probable effect that they will have on sales volume of the business, is extremely important to management in taking certain decisions. So the relationship between them makes up the profit structure of the company. So now the concept of break-even analysis. Concept of break-even analysis. The cost volume profit analysis is essential for a short-term profit planning that establishes relationship among cost, volume, and profit. The break-even analysis, or the break-even point, is the point, or is the level of activity, the level of production activity at which there is neither profit nor loss. That is what the break-even point is all about. Break-even point is the level of production at which profit sales offsets profit, and the profit sales offset cost, and the profit is zero. So there is a break-even there, such that the entire cost of producing that item has been recouped from the sales that were made, but leaving us with no profit. So we have been able to get to the point at which we can recoup all our costs, a certain production level that is good enough to enable us to recoup all our. So that's the break-even point. So to calculate the break-even point, you are looking at a situation where the total cost is equal to the total revenue, all right, and it gives you a zero profit. So that's that. So let's look at some of the assumptions that underlie break-even analysis. Assumptions that underlie break-even analysis. Assumptions that underlie break-even analysis. Break-even analysis and cost volume profit analysis are based on certain assumptions that are very key. One is the principle of cost variability. Principle of cost variability. Two, cost can be resolved or can be broken into fixed and variable components. Total fixed costs remain constant throughout the relevant range. Throughout the relevant range of production, fixed costs remain constant. Variable costs per unit vary proportionally with volume. Selling price does not change as volume changes. There is only one product. In this case, in the case of multiple products, sales mix remains constant. There will be no change in general price level. Production per unit remains constant. So these are some of the assumptions that underlie break-even analysis. Now we'll look at computation of break-even point analysis. It can be computed through different mathematical approaches, but the two most important mathematical way of looking at it is that the equation technique method or the contribution margin method. These are the two main techniques that are relevant in the computation of break-even point. Break-even point. One is the equation technique method. Two is the contribution margin technique method. So the volume profit ratio looks at the profit volume ratio, or what you call the contribution margin, which establishes the relationship between contribution and sales value, sales revenue, and things like that. So we will look at, we will look at the equation technique method. This technique uses formulas, different formulas. For example, sales at break-even point will be variable expenses. You add to fixed cost, then you add the zero profit, which gives you total revenue is equal to total cost, and profit will become zero. All right, the contribution margin method, the contribution margin method is also looking at your contribution. That's your contribution vis-a-vis your sales, your contribution as a ratio of your sales. So that's what that one is looking at. So basically, we have looked at the contribution margin method as well. So the various calculation methods that are also available, various case studies that are also available in your text, that will help you, to expand your knowledge in this area. So with that, we have also exhausted the issues around cost, volume, profit analysis. And with that, we come to the end of session 10. Thank you for listening.